Hello everyone, the latest data from China shows the evidence of the slowdown. Not just very weak export growth and very weak import growth. The fact that there's such weak import growth is also going to affect inflation expectations globally. The massive trade surplus of China is now 93% with the United States. What that means is that the Chinese economy is more and more dependent on the United States, while it is moving into a deficit, a trade deficit with many of its trade counterparts. So we need to pay a lot of attention to this, because this has absolutely nothing to do with trade wars. This has absolutely nothing to do with the Fed policy. This is happening in the middle of a very large stimulus in China, and it's the evidence of the impact of that stimulus. It's the evidence of the diminishing return of stimuli. If we look at the Eurozone, it's pretty much the same. In the peak of the ECB stimulus, the Eurozone economy is slowing down, and slowing down much faster than what consensus was expecting. Not just in Germany, but also France, Italy. We are continuously seeing shaving off of growth estimates. So all of this means lower inflation expectations, lower growth estimates, but also it's a very relevant thing to look at, because in terms of earnings growth and in terms of the multiple expansion that markets need, particularly with margin expansion, is going to be very difficult to see it when the largest economies, China, the Eurozone, and the United States, are showing lower levels of growth than those that we were expecting initially. And think about this: when we have been creating excess capacity globally in order to address the rising demand requirements of those large economies, and those large economies slow down, overcapacity rises, debt rises, and inflation comes down. Nothing to do with trade wars, nothing to do with the Fed, everything to do with debt saturation. Thank you very much.